markets, though, have really started off this year where they left off in December, so a pretty good run into January. JSE less than 2% of its all-time highs. Is it justified given where the economy is at the moment?
You know, we going into this year, our strategists were quite negative relative to consensus. And the first time I've seen people like Jonathan Garner, who's our emerging market strategist, much more bearish than he has historically been on emerging markets. And he's been right, you know, in his timing. And I think the reasons are he's very concerned about emerging market inflation, particularly in China. And I think what we saw today with an increase in the reserve ratio again for the Chinese banks is another indication that some of the emerging market countries are starting to get concerned about inflation. So they're taking up interest rates or taking away a bit of liquidity. And I think we're a little bit concerned about what that means both for equity markets and also for the economies in some of these emerging markets when some of the lax monetary policies that we've seen in the last couple of years starts to tighten a bit.
Are you including South Africa within that basket? Because we've been shielded to some extent from the inflation due to the strength of the rand over the past couple of months. Are we included there?
Yes, I would say so. I mean, if you look at commodity price inflation, it's pretty bad. You know, oil prices, wheat prices, corn prices, the whole commodity basket. And I think we still haven't got beyond that kind of labor cost inflation in South Africa. So yes, I do think South Africa is wrapped into that. And I'd be very surprised if we don't start hitting the upper band of our 3 to 6% inflation band this year.
Some would argue that our equity market's really been taking its cue from global markets, really ignoring the fundamentals in South Africa at this stage. What's the view then for developed markets going into the new year?
Yeah, we, a little bit like emerging markets, we're a little bit concerned, probably even more concerned about the US equity market than emerging markets. Our strategist, Adam Parker, he's new to the firm, but he's been at it for some time. His view is, look, when inflation becomes a problem, it's hard to argue for PE multiple expansion in equities. So that's one of his concerns, so that's consistent with Garner. The second thing is he thinks there are some tail risks out there, like the European debt situation, which again will put a cap on the kind of rating that you can put onto equity markets. And finally, I think what we're starting to see is the end of that sort of positive earnings revision cycle, where strong economy, you know, companies had kind of done well to cut costs, earnings came through. We're starting to see that level off now. In fact, if anything, earnings revisions are declining. Very difficult for equity markets to perform in a declining earnings revisions environment, and we think 2011 will be one of those environments.
We have seen some nascent signs of growth in the United States economy. We had ISM numbers, construction numbers out last week, looking pretty positive. If, as you think, inflation is also becoming a problem, does that mean interest rates are going to be going up sooner than we expected?
Yeah, I'm not sure about in the States. I think, frankly, the reason why equities continue to go up, in my view, is that because there's a lot of liquidity still out there and because other asset classes, cash, bonds, even property, commodities have had a big run, you know, where do you put your money? Equities is still a very interesting asset class because it's not that expensive relative to history. Dividend yields typically are going up. So I think, you know, equities are going to probably be okay. I don't see a massive sell-off, but we do see sort of single digits to low double digit returns this year, not the 20% plus that we've seen in the last couple of years.
Will we still see that foreign money propping up the South African equity market as well?
You know, I took a visit offshore in December and November to both Europe and the US to see some of our clients offshore. South Africa doesn't seem that top of mind with a lot of these emerging market investors. It just doesn't have the same kind of sex appeal as Brazil, China, India, that have much higher GDP growth rates, much lower penetrations of things like retail, consumer credit. And so what we're finding is that investors, particularly in a time where things are quite good, are prepared to look at some of the more higher beta markets like Russia and Brazil and so on. When things turn bad, South Africa tends to be seen as a defensive market, but that's not great. It just means we go down less than other emerging markets. And I think, unfortunately, that's probably the time that a foreign investor will start looking at South Africa more seriously again.
Within the South African equity space, though, we had industrials running pretty hard last year, but really pushed higher by retail stocks and a couple of the big caps like Richemont and Naspers as well. Do you think that the focus is going to switch to resources this year, just given the outlook you have for commodity prices at this point?
Yeah, I think unfortunately what resources in South Africa needs is a bit of a weakening rand. And it's a prisoner's dilemma. You know, it's very unusual for the rand to weaken and commodity prices to remain robust. But that's kind of what you're hoping for if you're an investor in South African commodity stocks. What we had last year was strong commodities but a strong rand, so therefore commodity stocks didn't really work. relative to your domestic, industrial, and consumer stocks. So if we get a weakening rand and we keep commodity prices high, absolutely that will be the place to be. But it is quite hard to paint that picture because they tend to be inversely correlated, those two.
How about outbound investment from South Africa this year? We saw some relaxation to the exchange controls announced in the mini budget back in November. We also have changes coming through for Regulation 28 of the Pension Fund Act, and that's really going to loosen things up for institutional investors, isn't it?
It is, yeah. In fact, my view is that the changes we've seen to Regulation 28 probably introduces the biggest change to the asset management industry in the last 20 years. That regulation hasn't changed since 1998. And it's important for two reasons. One is the one you mentioned, which is exchange controls are continue to be relaxed for pension fund investors. So if you were a pension fund, you can now put 25% offshore, it was 20%. If a unit trust, you can put 35% offshore, it was 30%. So increasingly, I think the South African investor is going to be more interested in what's going on in the rest of the world than they are just in the South African part of the world. And that's good for businesses like ours, good for CNBC. So I think that's positive. And I think it might cause a little bit of moderation in the strength of the rand. But frankly, we're not going to see this wall of money exiting the country because most of the pension fund liabilities are still in rands, and therefore you can't have 100% of your portfolio offshore. The second thing, and I think equally interesting, is that the type of asset that pension funds can invest in used to be very conservative. It was really equities and bonds and cash. Now, hedge funds, private equity, derivatives, commodities, these are all substantially increased in terms of the amount that pension funds can put into those asset classes. So I think what we're going to see is a renewed injection into the growth rates, into the private equity industry, the hedge fund industry, and frankly, some of the stuff we see listed on the exchange, corporate bonds, commodities. I think there's going to be some new sort of very interesting stuff that you and I can talk about going forward because of this.
Do you think this will go hand in hand with better regulation of these sectors, such as the hedge fund industry and the private equity industry?
Absolutely. I think it's brought so many of these things that were perceived to be behind cloak and dagger into the mainstream. And by the mainstream, we mean transparency, a bit more regulation, not hiding behind insurance wrappers or derivative structures. So I think, yes, the answer is trustees of pension funds are still going to have to be educating themselves about this new kind of type of asset class that their fund holders can invest in. But I think, yes, it's going to bring some of these things away from the shadows into the limelight.
Chris, if you were a South African investor with some fresh money to invest, where would you be putting it this year?
Look, I still like equities, but I would go for quality equities with sort of an improving dividend yield stream. I think people forget when equity markets return 30 to 40%, like we have in the last couple of years, how important dividends are to their long-term returns in equities. As much as 30 to 40% of sort of 20 to 30-year equity returns have come from dividends. So I would go after those stocks. And look, I still think pref shares for retail investors is a good bet. An after-tax yield of, I don't know, what is it, 6% or something like that? Not a bad deal.
And we have seen dividends coming back onto the table again as the recession's ended and companies have reinstituted those dividends.
Yep, a lot of them are sitting on a lot of cash. They're either doing deals, offshore we're seeing a lot of M&A activity, but I think locally dividend yields and dividend payout ratios have definitely gone up. And I think, again, to the point, if inflation becomes a concern and people are worried about an increase in local interest rates at some point this year, preference shares the yield you get on a preference share, because most of them are linked to prime, will catch a bid.